Welcome to Lunch Money. Coming up, is the property market back on the up? The new Best Buy savings account you should consider, and why two UK house builders are planning a mega merger. Hello, I'm Simon Lambert. Joining me on today's Lunch Money is This Is Money's Lee Boyce and Victoria Scholar from the show sponsor Interactive Investor. The property market has spent much of the last 18 months in the doldrums as higher mortgage rates have dented home buyers and sellers' ambitions. But all of a sudden, things have started to pick up. Mortgage rates have eased back a bit, house prices have steadied, and buyers look a bit more interested. Lee, we've had two reports out today on buyers and sellers. Do they show a little bit of confidence returning to the property market?
Most definitely, Simon. In fact, I'd say there's been three reports this week that have kind of really highlighted this. So first of all, we've had Halifax this week saying that property prices are up 2.5% to £291,029. They're up £4,000 on December alone. So that's quite a sizable jump, considering there's been lots of doomsayers out there saying we're due a house price crash. I mean, they're up 1.3% compared to January. So that looks rosy on the house price front. We've had RICS, which is a kind of temperature of estate agents and surveyors, saying that this is strongest buyer demand since February 2022, and that there's a rising number of buyer inquiries and more sellers coming to market. And then you've got Rightmove, essentially saying there's a record number of homeowners contacting estate agents for valuations last month. Put that all in together in a big sort of recipe pot, and you can see that actually things are looking a bit rosier when it comes to house prices and the housing market in general.
So if we look at the house price report there from Halifax, and Nationwide has said a similar thing, hasn't it? Now, obviously, these are two gigantic mortgage lenders. They base their house price reports on their own mortgage data. If they cut mortgage rates, their borrowers can afford to borrow more money and pay more for houses. So you've got a bit of a chicken and egg scenario there, haven't you? But the other bits of it do seem to indicate that this edge down in mortgage rates has definitely given buyers a bit more of a spring in their step, even though they're much higher than where they were before. Yeah,
so Halifax and Nationwide obviously give a huge snapshot and indication of what's happening with property prices across the country, and highly influential, and lots of people sort of live by them and read them and digest them. And it has really been falling mortgage rates since September that have helped boost that confidence. People were seeing mortgage rates being quoted in the press of 5%, 6%, 7%. That makes people quite nervy. When you start seeing mortgage rates coming below 4%, although not everyone's going to qualify for that mortgage, the whole market has shifted downwards somewhat. I mean, there was 50 lenders in January that reduced rates to some degree. So all of that has helped pump up the market a little bit. People might be more interested to move than they might have been, say, last summer, where mortgage rates were at their peak, and that's definitely given it a shot in the arm.
And how much does a belief that house prices aren't suddenly going to slump in the future affect buyer confidence?
It's really hard, isn't it? Because when you buy a home, it's obviously going to be the biggest outlay of your life, and especially if you're a first-time buyer. I mean, Halifax themselves say that the average first-time deposit is £53,000. That's a huge sum of money, so there's a lot of kind of nervousness, especially when you're a first-time buyer buying a home. But I spoke about this many times, Simon. We've heard it loads of times over the years that there's going to be a sudden house price crash, and it never comes to fruition. Now, we can't predict the future. We don't know what's going to happen. But a lot of what these reports are saying at the moment is that house prices are kind of tickling on nicely. You know, it's not like this pandemic when there was a massive boom and house prices went up 20% very, very quickly. So, you know, if you are looking to buy a home, the message I would say is to go for it. You can't forever just keep thinking there's going to be a house price crash, because we've talked about that for years and it hasn't come.
And what about for those people who are selling? Now, presumably, some of them will be looking at this and going, oh, great. But I mean, they're going to have to move themselves anyway, so they're probably going to have to buy. But they'll be thinking, okay, great, this is going to make things easier. They can't surely be expecting to get the same prices they were getting 2 years ago. So.
Well, yeah, I mean, it depends. It's all very localised, isn't it? It depends where you are in the country. And you're totally right. You've hit the nail on the head there, really. Like, if you're looking to upsize, for example, it's incredibly difficult to go from, say, a 2 or 3 bed to a 4 or 5 bed, if that's what you're after. The price difference are huge. They've also gone up probably even more significantly than your own property. And then we have the whole army of people that are looking to downsize. And that's a very hot piece of the market where it gets difficult chasing after things like bungalows and things like that when you're trying to kind of squeeze down the size of house you have. So there's lots of those kind of things going on in the market, very localised, different areas, different things are happening. But the best advice really is just to keep abreast of what's going on in your local area. And if you are looking to move, set up as many price alerts and things as you can possibly do and keep a gauge on the temperature of the market.
Now, savings rates have also been moving down along with mortgage rates, but there's a new Best Buy deal that's bucking the trend. What is it? Tell us about it. Is it worth taking?
It's worth considering, Simon, without a doubt. So it's Coventry Building Society. They've got a 5.15% easy access. I'm doing easy access like this because you can only access it 3 times a year, which will be enough for most people, I would suggest, but it means it's not strictly an easy access account. The only other snag as well is that it's online only. So if you're looking to go and open this in branch, you can't. It's just an online only rate. It does have the option for monthly interest to be paid into a nominated account though, which is a very popular feature for people. Just to put this into comparison as well, fixed rates, there's only one account that beats this 5.15% rate over all fixes. So it's worth considering. I mean, Coventry Building Society is the second biggest mutual in this country behind Nationwide, trusted brand. And we had someone open the account in the office this week who said it was a smooth process, very easy, and the money went in and it's there.
Well, there you go, a real live review. Thank you very much, Lee. The big news on the stock market this week has been a planned mega merger between 2 FTSE 100 house builders, Barratt and Redrow. Victoria, what are the details of this deal and why do these builders want to do it?
Well, it was a surprise announcement that Britain's largest home builder, Barratt Developments, offered to buy its smaller rival, Redrow, in a deal worth more than £2.5 billion. They say that this is to accelerate the delivery of houses that this country needs. We know, of course, there is a chronic shortage of housing supply in the UK, which might be part of the reason that we haven't had that crash that Lee was talking about. But the merger will allow the joint company to build a big range of different houses because they operate at different parts of the market, Redrow at the higher end and Barratt at the lower end. So a combined force could capture a much bigger part of the overall market. And the new Barratt-Redrow combination is also going to try and find major cost savings, look for those synergies, as looking to try and find £90 million of those by the third year.
So the bosses are trying to sell it to people, but will shareholders like it? What was the market reaction?
Well, I mean, for the two companies, it's pretty easy to understand the strategic fit. I think it's a case of strength in numbers, given the challenges that the sector is facing in terms of the higher interest rate environment, the cost inflationary pressures. I think that the market does like it. We saw shares in Redrow surge nearly 15% on Wednesday, clearly excited about the prospect of this tie-up. For Barratt, we saw its shares suffer, but that's pretty typical when that's the one that's purchasing another company. But I do think the market is behind the deal. There is, though, some hesitancy, of course, about whether it will actually happen. There are no guarantees. The regulator could have some concerns about competition and enlarged market share. So that will be something to watch out for in the months ahead.
Yes, competition amongst house builders is not really what it could be. Another place where we have had questions over competition is in the goods that we buy in the supermarket. Consumer goods giant Unilever, behind some of the most famous brands that we purchase, has reported results today. How is it doing?
Well, it's a bit of a mixed bag. Its CEO said that the overall performance needs to improve, but we did see a positive share price reaction because Unilever launched a €1.5 billion share buyback. Volumes increased for the first time in 10 quarters, but we saw the underlying operating profit was actually below analyst expectations, and operating margin was also a bit light versus forecasts, and that's because of the pressures from cost inflation that has been squeezing those margins.
Did Unilever give us any good news on inflation at all, or not say much?
Well, it said that inflation has been coming down in the second half of the year last year versus the double-digit price growth that we saw at the start of 2023. It did point to some areas where there was particularly high cost inflation. That was in nutrition and ice cream. And it also sounded a bit worried about the inflation picture in Europe. That seems to be where the cost pressures are hurting the business most at the moment.
Thank you very much, Victoria. That's all for today's Lunch Money. And it's the last episode of this series. We will be back soon with a new series, and watch out for some budget, ISA and end of tax year specials in the meantime. You can catch all the previous shows and also This Is Money's other video shows, such as the investing show, by searching for This Is Money on YouTube. Goodbye.